Welcome, guys. My name is Carlos. The idea today is to share in details a strategy that I shared the other day in the forum. So, a little bit about myself. I'm Brazilian. I am a aerospace engineer with a master's in computer science. Started my career some decades ago, worked for a famous bank, became an entrepreneur, sold to companies. I also had the opportunity to lead a global expansion of a tech unicorn in some places. And 5 or 6 years ago, I had the opportunity to start learning quantitative trading and machine learning applied to trading from Professor Tucker Bauch, who worked at JP Morgan, AI Research, is managing director there. And since then, I've been developing quantitative trading strategies and trading my own capital. And lately, I decided to do it in public and share some ideas and learnings at a blog, quantitativo.com. And additionally, I'm a huge fan of Quantopian. So this little background about me. One thing that I do a lot in order to get ideas, I read a lot of papers, books, blog, and sometimes I have time to listen to podcasts. And some time ago, I had the opportunity to listen to this podcast, Chat with Traders, an interview with Marsten Parker. For those who don't know him, he is quite famous. He's a self-taught programmer. He's a systematic trader with over 20 years of experience. He's the only purely systematic trader in Jack Schwager's unknown market wizards. He has a great track record, 20% of annual compounded return. He's been trading for over 2 decades. And when I was listening to this interview, he disclosed some of his strategies, and one of them was an IPO strategy. And it got me really curious because he introduced the strategy saying it's so simple that it's almost stupid. And he went then to describe his IPO strategy, and he described it in a pretty simple term. Well, basically what he said is, I define an IPO as any company recently listed. He didn't mention anything more than that, but I imagined something like 90 days. And then he went on and he explained, whenever the stock closes at a new all-time high, I buy. When I buy, I put a profit target and a stop loss, and that's it. And it really, really sparked my curiosity because how can such a simple strategy be profitable? And then he said that the strategy was extremely profitable over around a decade that he was trading the strategy. And I decided to test it. So how do we test a strategy like this? The way I think about like testing my process, basically I follow 4 steps. First, I try to quantify the edge. Then I backtest the strategy. While backtesting, I try fine-tuning and sometimes optimizing the strategy. And once I feel confident, I do a forward test. I forward test for some months. And once I really feel confident about the strategy, I deploy real capital. First step then is to quantify the edge. The way I think about quantifying the edge, basically, I created this chart because it kind of summarizes the way I see. It all starts with the market data. So we need to make sure we have good data because, as you guys know, garbage in, garbage out. If we don't have a good data set, it's impossible to test something and really derive something good if we don't start with good ingredients. So also regarding data, it's pretty important that we use a data set that is survivorship-bias-free. And finally, we get what we pay for. I really believe that whenever somebody show me like a free, quote unquote, free data set, I'm really skeptic about like free data because in the end, I truly believe you get what you pay for. Here, we are going to use Shahadar Core US Equities Bundle. If you guys don't know, it's a great data set. It's not that expensive. You guys can check the website. It's a good data set. Now, once we have market data, then we need to have a model. And the way I loosely define model is anything that we are going to put market data in, and this model is going to try to predict future returns. And here, model can be anything. Can be a set of rules, can be a factor model, can be a machine learning model. In our case today, it's set of rules, simple rules. And this model, in the end, we want it to have a high predictive power. It's an iterative process. So we tweak the model, we see its predictive power, and then we keep tweaking and iterating until we are satisfied with it. It's extremely important to test for statistical significance. Why? Because as we know, the financial market, stock market, there is a big component of randomness. So if we don't test for statistical significance, we may be fooled by randomness, as Taleb would say, and we could see results and not be sure that these results are actually driven by a model. It could be just by pure chance. So testing for significance is pretty important to ensure the results that we are getting, they are not generated by chance, by random. So the first thing that I do in my process is what happens in non-event. And here, in this case, a non-event, I am defining as what happens if we buy non-IPOs at all-time highs. This is the baseline. This is the baseline because we want to see a non-event compare with an event and ensure that the events, they are statistically significantly different than the non-event. So I'm not going to go into a lot of details here, but the first thing we need to do is to extract the data. So it's a query where we are going to extract the data. So we select here all non-IPOs. The key line here is the line 33. What is an IPO as we defined? We define an IPO as any stock that is listed and has less than 90 days of trading history. So a non-IPO is any stock that has more than 90 days. So line 33, you can see the 90 days criteria. Important, we also filter mid, large, and mega cap, line 32. That's important. We are not looking to small cap IPOs. And here I looked 1, 5, 10, and 20 days into the future. So lines 13 to 28. I ended up using 20 days, but I also looked what would be the effect on 1, 5, and 10 days as well. This is the first part of the query to extract the data. The second part is pretty straightforward. We are looking at all-time highs. So this is line 49. You can see there when close is equal to the previous max. So looking at all-time highs. Once we extract the data and we arrange it nicely, which is the code on the left, generating the table in the right, we can see that we have a little bit over 500,000 events, which are non-events. What would happen if we would buy non-IPO and hold for 20 days? We can see that if we buy non-IPOs and hold for 20 days, the expected return is 1.14%, which is basically there's a 55% chance that we get it right. If we get it right, the expected return is 7.36%. And there is a 45% chance we get it wrong. If we get it wrong, we lose 6.59%. So basically, this is the distribution of returns of non-events. Now, to compare, let's see what happens if we buy an IPO at all-time highs. The query is basically the same with one difference, which is in line 37. Instead of more than 90 days, we're selecting less than 90 days, which is our definition of IPOs. We continue filtering mid, large, and mega caps. And we continue looking 1, 5, 10, and 20 days into the future. The second part of this query, it's almost exactly the same with one difference, which is line 53. We exclude the very first IPO base. So what this does is we are going to look into buying whenever an IPO hits an all-time high, excluding, of course, the very first day, because the very first day of an IPO, by definition, is an all-time high. So we start looking from the second day of listing until the 89th day. All right? So extracting this data, code in the left, generate the table in the right, we can see that in the period that we are analyzing, there are close to 20,000 events, over 19,000 events. And we see here that the expected return of buying all-time high IPOs and holding for 20 days is close to 4%. So it's about 4 times the non-events. This is composed by basically, if we get it right, the positive events, 57% chance. If we get it right, it's over 14% return, the expected return of positive events. And negative events, if we get it wrong, there's a 43% chance we get it wrong. If we do get it wrong, we lose 10%. So these are the statistics of buying IPOs at all-time high and buying non-IPOs at all-time high. Now, the next step, as I mentioned, we need to test for statistical significance. Are the events statistically different than the non-events, or are these differences caused by randomness? So testing for statistical significance in Python is pretty straightforward. The code in the left, by running it, we can see the statistic, we can see the p-value. The p-value here, what we are comparing the two distributions, the distributions of returns. And what the statistical test does, it tests the means of the distribution. So as we see that the p-value is well below 5%, the means of the two distributions are significantly different. So we can affirm that the results that we are seeing, they are not generated by chance. So we do have an edge. Once we get to that point, now we can go and formulate a strategy based on these results and then backtest. Before we formulate the strategy and backtest, a nice thing I sometimes do is visualizing the distribution. So here, the code in the left generates this chart in the right, which is basically a visualization of both distributions. In purple, we can see the distribution of returns of the IPOs. So what happens if we buy IPOs at all-time highs and hold for 20 days? What happens if we compare that with non-buying and holding for 20 days, non-IPOs, which is the yellowish chart? And here we can see clearly that the edge, why does it work? Because we have fatter tails. We can see the fatter tails, and of course, it's positively skewed. So we have a fatter tail on the right in comparison to the left. So that's why this edge works statistically. At this point, I started to wonder, why the heck does this edge exist? And we don't know for sure. We can think on some hypotheses. So here are some hypotheses. IPOs, they get a lot of attention. There's a lot of hype. Usually IPOs get a lot of institutional support. The key stakeholders, usually they have lockup periods. And in these periods, they cannot sell IPOs. There's market sentiment, momentum, behavior biases. I mean, there are a lot of hypotheses that can explain this, but the truth is, we don't know. We observe the statistical anomaly. We can hypothesize why it happens, but we don't know. Now, let's formulate the strategy in details and backtest. First, let's formulate the strategy in details. Here, this is my interpretation of what I heard from Marsten in his interview. Now, all the details here, he didn't give any of these details. So this is my interpretation. So the rules that I came up with is, first, we're going to split our capital into n slots, and we're going to try different slots, 5, 10, 20, 30, and 40, and buy all IPOs at all-time high as long as less than this maximum number of lots. Second, we'll never buy an IPO on its very first trading day. Third, if there are more IPOs at all-time high than the number of lots, we're going to order them by market cap and prioritize the larger ones. 4, we're going to set up profit target, P, and a trailing stop loss with value L, and we're going to play with P and L. We are going to keep the position until one of the two orders is triggered, either the profit target or the trailing stop loss. And once the slots are reopened, once one of the orders are triggered and the slot, of course, are reopened, we're going to fill them again with the new IPOs at all-time high, and we're going to keep refilling with IPO. Important. What is a good value for N? So what I did here, when I asked myself, okay, we need to go and backtest it, but how many IPOs, what's a good value for N? And what the code in the left here does is it goes through the data set and count how many opportunities, how many IPOs are available in each day throughout the whole period. And that's what I am showing here in the chart on the right. So you can see how much it varies. The red line is the average throughout the period. This average is 27, but we can see that there are moments, depending on the market regime, there are moments where we see more IPOs. There are moments in bearish market, like you guys can see after 2008, that we have less IPOs, so on and so forth. So 27 is the average. So starting with N, 20 would be a reasonable number. So let's go back test. Here, guys, my idea here is to show you the logic in some detail. I'm not going to dive into a lot of details here, just like a big overview of the code. I use backtesting software that I wrote it myself when I was in my master's degree. But basically, it's a simple event-driven backtest. You can see here the structure of the class. In the beginning, you guys can see that there are some parameters that we can tweak. So maximum number of positions, which is N, whether we're going to use trailing stops or not, the profit target, the stop loss target, if we use time stops or not. And then we have mainly 3 methods. The first method that I'm going to show you in a second is the method called compute signal. This method called once at the beginning of the backtest. The second method, important here in our runs, is the method get IPO, which gets as an input the bar, the date, and then it does what you guys can imagine, returns a list of the IPOs for that specific date, for that specific bar. And the last and the most important method in our class, in our backtest class, is the method iterate. This method is called every day at every timestamp in the backtest. And in this method, we write the logic to buy and sell. All right? So let's go into details and you guys are going to see what's happening here. First, the compute signal. Here, the compute signals, what this method is doing is basically it computing the maximum price of all our assets. Why is that important? That's important for us to identify whenever an asset is at all-time high. So basically, the few lines of code here, they are doing this. The second, in the bottom of the screen, there is the method get IPOs. And it's pretty simple. It's only one line. Why is that? Because I am pre-computing before running any backtests. I pre-computed and I loaded in a data frame all the IPOs per date, which is this self.ipo. Why did I do that? Because as I run lots and lots and lots of experiments, there was no point of computing and recomputing again and again and again the IPO. So I pre-computed it and I saved it, I cached it to speed up the process. Our last method is the method iterate. There's a lot here. Let's go step by step. The first part of the code here on the method, first, we get the positions, we get the number of positions, and we get the number of slots. Remember, the baseline here, the maximum number of slots that we have is 20. So we never buy more than 20 IPOs. So the first part of the code, we get the number of positions and we get the number of free slots. Then we check the exit rules for every asset we are currently holding. The first part of this code here, we compute the prices that trigger the profit and the stop loss orders. And then we check whether either the profit, target loss, or the stop loss order, they were triggered. So we check for the exit rule. Then we compute the cash, the allocation per position, depending on the number of free slots that we have and the cash that we have available. So we have an allocation per position. Finally, we check the entry rule for all available IPOs in this specific date while there are lots. Pretty simple, right? So running this, we get some results. So here, the first set of experiments that I run 5 experiments varying the number of slots, which is the first line in the table. So you can see I run for n equals 5, 10, 20, 30, and 40. Important, the second line is pretty important, which is the average cash utilization. What this line is telling us is this. In this line, I am computing every day how much cash is sitting idle in the account. So I get the percentage of cash sitting idle in every day and I average it. So when I have 5 slots, the average cash utilization is almost 80%. Contrast that with the experiment number 5, when I have 40 slots, the average cash utilization is close to 25%. So here we can draw an interesting conclusion, which is when we reduce the number of slots, we improve the cash utilization, thus increasing the annual returns. But in that case, we reduce the diversification, which increases the risk, which means lower Sharpe and higher drawdown, which is experiments 1 and 2. In the other hand, when we increase the number of slots, experiments 4 and 5, we increase the diversification, thus reducing the risk. So we have higher Sharpe, we have lower drawdowns, but we reduce the cash utilization, which reduces the total return. So in order to move forward here, I selected n equals 20, which is the middle experiment, the experiment number 3. After that, I tried a second set of experiments playing with the profit target, which is the first line of the table, and the stop loss, which is the second line of the table. So here we can draw a lot of conclusions. So when we look at experiments number 1 and experiment number 5, we see that when we increase the profit target and the stop loss, we get better results. So contrast experiment number 5, profit target 7%, stop loss 4%, with experiment number 1, profit target 15%, stop loss 10%. We jump from annual return from 12% to 16%. So increasing profit target and stop loss, the way I see it, like giving our strategy breathing room. So the strategy can breathe. So we can get more results. So this is the first conclusion that we can draw from this set of experiments. The second conclusion that we can draw from these experiments is by looking at experiment number 1 and experiment number 4. Having a favorable payoff is important. What do I mean by that? Look at experiments number 1 and number 4. Experiment number 4 has a profit target 15 and a stop loss 15. So it's 1-to-1. The ratio, the payoff ratio, profit to stop loss. Look now at the experiment number 1. Profit target 15%, stop loss 10%. So it's 1.5-to-1. So experiment number 1 has a favorable payoff. And we can see that by having a favorable payoff, we move from 14% annual return, which is experiment number 4 annual return, to 16%, which is experiment number 1. This is the second conclusion that we can draw from this table. The third conclusion we can draw by looking at experiments 2 and 3, which is this. Improving the payoff of the profit and loss even further can boost the returns. We can look at experiment 2 and 3. So we have in experiment number 2, profit target 20%, stop loss 15%, versus experiment number 3, profit target 20%, stop loss 10%, is 2-to-1. And we can see that we can boost the return a little bit. So we move from 16.9% to 17.8%, almost a point. And the experiment number 3, profit target 20%, stop loss at 10%. Remember, trailing stop loss. This is the best experiment that we got. So this is the best setup that we got. Here, there's an interesting thing that Marsten mentioned in his interview that we can see here, which is pretty curious, which is this strategy, it has a natural filter for bearish market. We can see here, around 2008, the strategy is kind of flat. While the market, we can see a big drawdown in the S&P after the 2008 crisis. And why is the strategy flat? It's flat because whenever we have bearish market, the number of IPO, it reduces. So the strategy has baked in a natural filter, so which is great. So we can see here the overall stats. We get close to 20% annual return, Sharpe ratio of 1.4%. We are invested close to 100% of the time. The maximum drawdown is less than 20%, which is great. And here we can see on the table on the right, some stats about the trades. So we have close to 100 trades per year, which is okay. The expected return per trade is 3.7, 3.68%, which is not coincident, pretty close to the 4% that we saw when we were doing the statistical tests. the win rate is close to 44%. The win rate is below 50%, but the payoff ratio is great. When we get it right, we get 20% a return. When you get it wrong, we lose 9%. So it's better than 2-to-1, the payoff ratio. Oh, it's a great setup. Last but not least, when we see the monthly, annual, and annual returns, we can see that the strategy had only 2 down years since 2001, which were 2008 and 2011. 66%, 2/3 of the months were positive. The best month was an incredible close to 50% in October 21st. If you guys are curious about this month was Trump's IPO through social. It was called another thing. It was another ticker, but this was this huge month. The worst month we had was November 21st, -9%. The longest positive streak, I love to look at these numbers. The longest positive streak, 13 months from August 02 to August 03, and the longest negative streak, 5 months, June 08 to September 08. Why do I love to look at these streaks? Because when we go live, it's important, at least for me, to know that we might have periods of negative months. So I find it's really important to really know this. Final thoughts. The key thing about the strategy, in my point of view, the capital utilization. The capital utilization on average is 66.7%. What does this mean? This means that at any given day, on average, there is 1/3 of capital sitting idle. If we had 100% capital utilization, instead of 18% annual return, we would get 27%. So when I finished this exercise, I was thinking, how could we improve the capital utilization? And I mean, there are some ideas. One idea that came to my mind is like to test a dynamic number of slots, because remember, we are setting fixed number of lots. So regardless of the moment in the market, either bullish or bearish, we are getting our capital, splitting in 20 slots and deploying against these 20 slots. If we are in a bull market, we have way more than 20 IPOs in a given day, so no problem. The problem is that when we are in a bear market, we have usually less than 20 opportunities in a given day. So if we have a fixed number of slots, this means that we are going to invest in all opportunities, but we are going to have cash sitting idle in our account. And this is, of course, not good. The second thing that comes to mind is that the strategy is long only. And you guys can say, oh, Carlos, of course, is long only. It's basically impossible to short an IPO. Yes. But what could we do to add a short leg on the strategy? And one thing that came to my mind while discussing with colleagues was an idea. For example, what if we shorted the lowest performing incumbent in the sector of the IPO? So imagine this. For each IPO, we're going to look at the sector in which the IPO is happening. We're going to get the lowest performing stock in that sector, and we are going to short that lowest performing stock in that sector. For every IPO, short the lowest performing incumbent. So this was an idea. Of course, it's just a theory. We need to test it. And the last final thing, the last final thought, which is something that Marsten said in his interview, is that the strategy is not performing well since 2022. And the question that we ask ourselves is it temporary or is it permanent? Marsten thinks it might be permanent because he believe that several companies, they are finding other ways of raising capital, not in the public markets. So private markets continue raising capital from venture capitalists, from private equity. And the truth is, in the end, we don't know. But this is the final thought. So that's it. I think we have like 15 minutes for questions. So if you guys want to reach out later on, continue the discussion, these are my contacts. So I'll be happy to try to answer any questions. Do you guys have any questions, comments, input?
Hey, Carlos, me here.
Yes.
Sorry, I was just going to say thank you for the, didn't expect that when I first started about it, trading off IPO. Really wanted to know the reasoning behind it. Pretty cool.
Cool. Thank you. The credit is to Marsten Parker. I just heard the idea and implemented.
And that's an unknown market wizard, right? That's the latest one. One of the
Yes.
latest ones.
Yes.
How often does your strategy run? Since you say you use this to trade your own money, and IPOs only come out around so often. How often does this one run in particular?
No. This one specific, I usually deploy my capital. This one specifically, I am for testing it. I didn't deploy any capital yet. I think a couple of months, so not that much. Usually, I let it run for around 6 months before deploying real money.
Okay, like in a paper demo.
Yes.
Carlos, quick question. If you don't mind, could you go back to the stop loss portion of the presentation? Kind of wanted some more clarity on how, when we put the stop loss order on it, what are we putting it on the closing price on that day?
Oh, that's a great question. And usually when I get an idea from someone describing it in a podcast, which was this case, usually the guy telling the idea, he doesn't give all the details.
Right.
So what I heard was, I put a profit target and I put a stop loss and that's it. And what I had to do is I tried a simple stop loss and then a trailing stop loss. But if I'm not mistaken, he didn't mention in details how he was implementing the stop. So usually this kind of detail, we need to figure out ourselves. So I tried both. I tried a basic stop. So the first thing that I tried was the most basic one. So when I buy at the price X, so I put a stop loss 0.9x when I buy. This was the first thing that I tried. But it was not the final stop loss that I'm using in the strategy. The final stop loss that I'm using in the strategy is a trailing stop loss. And what is that? The trailing stop loss does this. Every day looks at the maximum past price and 0.9, for example, the maximum previous price. I can even show you here the code. Here, you can see line 59 to 62. In fact, line 62 is exactly what we are talking. You can see, can you see there?
Yes, I can.
So, I mean, it's past max. It's the trailing stop there.
Got it. Okay. Thank you. I appreciate it.
Hi, can you hear me?
Yes.
Oh, okay, great. Awesome presentation.
ahead.
Why is the first day's data ignored?
The first day is ignored because we are buying IPOs at all-time high. If we include the first day, this means we would have to buy all IPOs. That doesn't make sense to me.
By default, yes.
That would mean a strategy that buys all IPOs. And that doesn't make sense to me.
Okay, got it. And again, I assume we got plans to use some analysis on secondaries as opposed to IPOs.
What do you mean with secondaries?
IPOs are primary share issues. Secondaries are just, one company decides to go raise again for stock that's already trading, right? I think that would be an interesting comparison.
Oh, yeah, that would be
That answers your shorting question, because then you can already short existing stock or
yeah, that will be an interesting idea. I just need to check if in the data set that I have, which is, as I mentioned at the beginning, the Shahada Core US Equities Bundle, if we have there secondaries, that specific event. If we do, if we do have that event, we could test your idea. I think it's a great idea. Great idea. Great idea.
Thanks for the presentation.
No, welcome. It was a lot of fun testing it, and a lot of fun now sharing that with you, because in the end, I think when we share the idea and we have the discussions, then a lot of new ideas can come up. So like this one that you just mentioned, secondaries. What else? More question? It's free. I have a question. Would it be beneficial to split equal amount into different sectors? That's an interesting question. So we would need to check the IPOs by sector and see if, instead of splitting the capital equally between opportunities, split the capital equally between sectors. So if we have more IPOs in a given sector, less capital to each IPO, so that we can balance the sectors. It's a good idea. I think it's a good idea. We need to try it. I don't know. I think I'm not sure if we have enough, because remember, we have on average 27 IPO. Yeah, if we take n equals to 5 for each sector and combine it, maybe yes, that makes sense. Because one thing that concerns me is that this might improve the risk profile, but this idea, I'm not sure that it would address the capital utilization point. Because for us to address the capital utilization problem, the question that I keep asking myself is, how do we deploy all the capital? So, because remember, here, if we have n equals 5, so we only deploy capital against 5 IPOs maximum at any given moment, this is close to 80% average cash utilization, 19% annual return, but look at the maximum drawdown, look at the Sharpe ratio. It's a lot of risk. So I think the sector might be a good idea to reduce the risk. Yeah, we would have to try it out. We would have to try it out. I don't know, Nicholas, we would have to try it. I think it might be a good idea as well. Yeah, it was a great question. Yes. All great questions. I mean, I think this was a great strategy shared by Marsten. It was fun developing it, investigating it. Hopefully it will continue to work. The strategy will forward test well, and we'll be able to deploy real capital against it. Thank you for joining. Thank you so much. Thanks for the question. It was great sharing here with you. If you guys have any more questions, comments, ideas, if you guys want to connect at quantitativo.com, my email cs@quantitativo.com or Twitter @quantitativo1. All right? So that was it. Thank
Thank you,
you.
Carlos.
Thank you. Bye-bye.